Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, October 4th, 2021. Do a quick update on the markets here and a few of the other asset classes I've been watching, commodities, metals, things like that. It won't be a long video. Did want to mention we have now hit T5 on the SPY chart. This is a 60-minute chart of SPY. Remember, we got our sell signal all the way back here, and we broke these 60-minute uptrend lines, rising wedge patterns on SPY and QQQ. So far the biggest correction of the year, and I think more to come. So that's T5. I'm really focused on QQQ, but I've also laid out these targets I've had here for a while in SPY. Check 1, check 2, check 3, check 4, where a tradable bounce was expected, and we got. Ran up really to that downtrend line. So here's what you want to watch on SPY right now in 60-minute chart. You do have a downtrend line off the highs. You still have those divergences, but this is what I've been talking about. And this is, said it last week. I'll say it again. That was one of the most bullish setups when we had positive divergence on both SPY and QQQ. But so far it hasn't played out. Doesn't mean it won't, but I still don't think it will. So that's trade it as you want. You can see that we had the nice confirmed divergence right there. We had the PPO crossover. So it was official, at least on SPY right here, by my book. Again, this is not in textbooks. This is what I call confirmed divergence, when you get the bullish crossover on the PPO to effectively put in a higher low on indicators. And so you had it there, but they stepped in. This is where, once again, the bulls should have taken the ball and run, but they didn't. And it's been met by more selling, and that took us down to the fifth target there. And let's look at QQQ. Now you can see also I have a line here on this chart. This purple line, I've had it here a long time. It's at negative 0.44. That's on the PPO. In other words, here's your PPO zero line right there. And I look at the white line, the signal line, and when it crosses below that, that's often when you get more significant trend changes. So we're a few whipsaws on this chart. Be honest with you, I'll probably pull that line down a little bit now. I always say this, I'm flexible. If the charts change over time, certain levels change, certain indicators, that's what I'm looking at. So there it is. That would be quite bearish if we take that out. Why? Well, number one, for that reason, like I said, bull trend, that 9 EMA, the signal line is usually above that. Now I have the line at about 0.56, not much lower, but you can see that's where the white line. Again, the white line's the last of the two to cross, not the blue line. That helps filter out whipsaws. And then more so, like I said, I want to see these divergences taken out, because this is the first time in months that we've had nice positive divergence on the 60-minute charts of SPY, QQQ, NQ, and ES. And if that doesn't play out, then that is a definite change of character in the markets, because every other time for months now that we've had these markets going on to new highs. So let's see what happens. Let's jump on to the next one, and then I'll wrap this video up after looking at a few more charts. Here's QQQ. So again, we had that nice positive divergence in place last week. Here was our bearish PPO crossover that confirmed it. Started to go, but we had another failure to launch. The buyers failed to follow through. The sellers stepped in, and so far these clearly bullish developments, especially when you fall down to key support, they're failing to play out for a rally. And again, to me, that's one thing you have to look for. We've been in really since COVID first hit, in the Federal, the Federal Reserve came out with a nuclear response. We've been in one of the strongest bull runs in history, and so what you want to look for is a change of character, and that's what we're seeing. And where I'm going with all this is there may be quite a bit more, and that's what I said earlier today. I'll watch what happens here, and I may very well extend this. Somebody said last week, wow, that was aggressive targets adding T3, and I said, no, not at all. That's barely constitutes a correction. It's defined by a drop of 10% or more. So to me, that's a pretty conservative target, and that's where been living in these 60-minute charts, and that's where I can see the reaction very likely. But there's certainly the potential for a lot more when you zoom out to the daily and even weekly charts. All right, so we'll see where we go. We're coming up on, so as SPY just hit that target, which is also support. Obviously, you have minor support here at about 348.85. I'll change that line color it down a little bit to show you that the bigger support level is that T3 level. Technically, the support's lower. If you want to hold out, trail stops down. A lot of ways to trade this, and that's why I do these videos and talk about this. We may or may not even get a reaction there, since there's a potential for a bigger drop. You have to pick your trading style, your strategy for this trade. If you hit, let's say you swing it down from the highs and you get this drop of whatever it was, from roughly 10% drop. Of course, that's what I was just saying. Let's say you get most of that, but that's a nice trade, especially in short order. The drop, the market dropping 10% in a matter of just a couple weeks here. What is that? About 3 weeks. That's what it took. If you go back this way, that's wiped out so far over 3 months of gains. This is going back 3.5 months right here, meaning everybody that bought here is underwater, and that's why I like trading corrections. The gains are a lot faster. It's like trading a bull market or a bull trend in fast forward. You got to be quick. That's the thing. You can't stay too late to the party, because once it's over, usually snap back pretty good. But I'll continue to do these updates actively, and like I said, I see absolutely no reason. My convictions are much stronger than going in Friday, because we now know those divergences so far have failed to play out. We're down pretty impulsively today. I'll get to some of the individual fangs here in a second. Let me just give you an update on the futures. ES, the S&P 500 E-mini futures. This is a 2-hour, 120-minute candle chart going back 6 months. This trend line here was our primary trend line. It goes to the left of the chart. That's all I can go back on a 2-hour. But it picks up reaction lows way to the left of there. And this was a big sell signal. Here's just so you can kind of get a feel for what happens. And so I point out these little 60-minute divergences. You go along, get these divergent highs, and you get little corrections, anywhere from a few percentage points, maybe 5, 6, 7. Divergent high correction, divergent high correction, divergent high correction, divergent high correction. But what made this one different, this one right here, this divergent high, other than all these other divergent highs? That was a very impulsive breakdown of a very significant long-term trend line. So these were just corrections in a bull trend. All of them tradable, but this one triggered a longer term or more powerful, more significant sell signal. And if you missed that initial run, it was pointed out here, you had a back test of the trend line, which also offered an objective short. Then you had a breakdown of the minor uptrend line right there, providing yet another objective short entry, and that's where we're at. So what's happening now is there was that divergence that was in place. As we headed into the end of the week, we started to rally, and what happened is there was no follow-through. So it shows there are more sellers than buyers right now. They sold that rip, and dip buyers, as they do, it's been working out great, and that strategy works till it stops working. So they bought these dips. We had these rallies, and this is where it starts to change. What's going on here? This is the dip buyer's mindset. What's going on? Buying these dips, and suddenly it's not working. And so what will happen is, as they should be, a lot of dip buyers will buy a dip and then set a stop below a reaction low. So when those reaction lows are taken out, that's bearish. But we'll say this: we're coming up on big support here at about 42.19, no, 42.20 we'll call it. That's my next target. And so there's not that much more downside before we hit really good support. Most likely get a reaction there. Again, I talked about that. No guarantees. If you go right through there like it's not even there, or let's just say we have a very minor muted reaction and then drop down to the next one, that's going to be quite bearish. And then, then I'll certainly extend targets. And I do these videos. I also throw those targets out so you have them in advance. If we take out 42.20 on ES, we're probably going to drop down to 4100. That's the next pretty decent support down there. So those are potential targets. And then, of course, finally, if we keep moving lower and we don't bounce there, watch these divergences. We can go a little bit lower. We might still have the divergences if we hit 42.20 and 4100. But ideally, you want to see them on QQQ, SPY, ES, and NQ. And I'd like to see them on the 60-minute charts and these 120-minute charts as well. Let me look at NQ, and we'll move on. NQ, We're at or just a hair below support. This was my next target on NQ. These were all the targets. There was our uptrend line on NQ. Again, it goes off to the left of the chart. Major sell signal given right there after that divergent high. Little snapback rally right up to where the breakdown occurred, and nothing but selling so far. So 14,435-ish right there. That was that next target, which has now been hit. So there's another, hitting these targets. We hit that one back there, had a bounce, tradable bounce, suggested to go long if you were an active trader, and then reverse. And now we're at the next support level. But reaction or not, I'd be surprised if we didn't get a little bit of reaction here. Not shocked, but I do think we're coming down here. Let's keep it very simple. That's 14.0, roughly 14.050, somewhere around there, 14.052. And if hit, that's going to be about another 2.5% or so downside. So I think last week when we were up here somewhere, I said we had another 5% downside. So, well, we're down to, you can see it right here on the bottom. We're down 2.5% right now, 2.52% on NQ. So that puts us half. That's that other halfway to the 5% drop from last week. We're right there, right on target. So, again, at this point, like I said last week, I'm surprised it's taken this long to kind of get that impulsive selling going. But I mentioned it last week. I think we're at what I call the point of recognition, or POR, where dip buyers realize, ruh-roh, something's wrong. I'm buying these dips, and I keep buying and adding down, and I'm getting more and more underwater. And that's where usually you see more impulsive selling and reactions that support, especially if they're not big support levels. If they're only minor support, are usually fleeting to none. In other words, you get a very small or short bounce, and then you go on down there. So that's my thoughts where we're going near term. And we get there, and I wouldn't be surprised if we head down there hard. We get a momentum fueled overshoot. So just if we go down and quickly break 14.050, 050, we could easily snap back up, and I'll just have to assess it and see how things look if and when we get there. And QQQ, remember on the daily chart, this is the first resistance I see back here. You have a big thin zone. Some people I know you can't make it out. I get the comments you can't see in the videos. Yeah, it's all monitor resolution. I can see them on the playback on my monitor. I have these lines turned down, but it's the volume price histogram. You have bars that run out to right here, big bars. It says a lot of people bought in this area. That's volume at price. And so a lot of people, they've all been trapped. All those longs that bought here are now underwater, going back for a few months. This goes back to June when we got into that range. And it's a thin zone all the way here. The volume price bar stop right here. Then it picks up right there. So that's where 342.41 and the 200 days, that's where I figured we'd be heading to once we got this sell signal back here. And that's still where I think if you want to step in long, certainly objective, reverse from short to long. And again, daily chart, you're going to maybe overshoot. It's not unusual to overshoot those levels. And but if you're holding out for an overshoot, sometimes a buyer's stepping a hair early. Best thing to do is, again, if your plan is to reverse long there, cover shorts, is do it right around on that level, or put a tight trailing stop if you want to overshoot it. Again, tight trailing you can do as much as you want. I think most brokers will let you trail a 1 cent stop if you want, but you don't do it too tight, maybe 1% or a couple percentage points. And that will allow you to maybe milk a little more of the overshoot if you want to, and also avoid missing out a reversal if it comes quick. I don't see a reversal coming right away, at least not right now. I know we're oversold here on the daily chart for the first time in a while, but during corrections, oversold can become more oversold. So that's what we look like. Bottom line, more downside likely to the tune of about another, again, 2.5%. Lines up. SPY has some decent support here, really more of a range from about 420, 450 down to about 420, about 422 right there. So maybe a little less downside on SPY. But if that doesn't hold, remember you have the 200 days on the S&P 500 are also down here at about another, that's actually about 3.4% or so 3.3% till we get down to the 200 days and that 411 area. So that could happen as well in SPY. Right now, it's mostly those tech-heavy, market-leading FANG stocks, and that segues into an update there. So we have Apple. Level I've been watching on the 60-minute charts last week. Told you 141.59 was pretty significant near-term support. Look at all these big volume price histogram bars right here. They go out to there, right there. You have some big ones here, and then it gets real thin right here. And that was a level I wanted to see break, and that's what happened. We broke that level. So that is the bearish side. We get a check mark for that. We got that sell signal I was waiting for on Apple. However, you have to respect you have a bullish falling wedge pattern. Nice clean one too right now. Again, we've had divergence. There were a couple opportunities for the bulls to take it and run, and they didn't. But they haven't yet, taken out, Apple has not yet taken out these divergences by making lower lows in the indicators. So I just wanted to point that out, and this is why you need to be flexible and watch this stuff. I have minor support. This is 137.90 right there, and then better support down here at about 135.19, and that's where I think Apple's going to go most likely before a bounce. So this wedge could morph something like this. Either way, watch for a break of that uptrend line. Watch for recovery back above 141.60. If you're short or if you're bullish and you want to buy Apple, that's where I think you can either wait for a breakout above that level or maybe a pullback to that 135.19. That should roughly correlate with the targets. Yep, that's 2.5%. So it aligns with that QQQ target. No guarantee we'll get there, but if we do, then that's also an objective place to take a long with a stop somewhat below. Somewhat means you might want to hold off on the first 60-minute candle, maybe wait for a second 60-minute candle close solidly below it, or even a daily close. It all depends on your trading style. But there it is. So we'll watch this, and if we get that, it's going to be the first divergent low in a while on Apple. We could go a little bit lower, keep those divergences intact. And so maybe a half position long there. If you're to be bullish Apples, to be bullish the Qs, by the way, guys, of course, biggest holding. And then maybe, add on a breakout above the downtrend line and or that 142 level. But as of now, I think there's a little more downside left. Microsoft took out that 283.73 support, not by a whole lot. And same story, probably come down here. Roundabouts, maybe that 274.60 next support, and in doing so, we could have some divergences there, so there might be a reversal. Big volume price histogram bars here too. So if it breaks that, this is where it could get really ugly. I'm talking about levels that the buyers may step in and might be objective, but this market, I've been talking about it for a long time, and people have become very complacent just because we haven't had even a half decent correction. This is the biggest one in months. Again, there's with the complacency in the market right now, we could, and the technicals, by the way, and the technical posture, we could certainly see a much bigger drop. And if we do, that would be a likely target on Microsoft. That's 255.76 or so, and that's a drop of about another almost 9%. All right, let's look at the daily on Microsoft. Took out the trend line, and you can see here too, pretty good support. It's flirting with right now, about 283. And so same story. If it drops, we're probably going to come and visit the 200-day moving averages. Maybe this reaction high right here. That's at about roughly 263. And again, to try to measure it out for you, that would be a drop of roughly about 7.5–8% if that happens. So. Well, we are at support right now. We're a hair below it on a daily candlestick. That doesn't matter because at the end of the day, we can reverse and close back on it. And you can see Microsoft has been trading on that 283 support for a while. So these are the things I'm watching. And just like Microsoft had, I just forwarded to the next chart, Alphabet. But you have these big divergences, and this tells me that you have the potential for a much larger drop. Look at Alphabet taking out this trend line. Let me look at the other share class for you as well. They show the same thing. You have these nice uptrend lines right here that have been cracked. I'm referring to this one right here, the primary uptrend line off the what I call the COVID lows back in March of 2020. And we recently had a sell signal breakdown, back test, beautiful back test, and we're moving lower. And this thing's way above the 200s. So even just a pullback to the 200s and a successful test would be healthy. And there's plenty of support levels to target down there. I just want to kind of give you, hopefully that helps, the technical posture, how all these guys look. There's Facebook. Facebook went down today. I don't know if it's still down. Went down about probably 45 minutes ago. I heard Instagram and some of the others went down as well. Does it have anything to do with the whistleblower that just came out? Or that damning report? Who knows? But they're down. And here, let me see if they're back up. No, it looks like they're still down. I don't, I'm not an active Facebook user, so I don't know if that's what's a normal outage for them. But yeah, that's obviously not good for the stock, nor is the, what the whistleblowers' claims are. But that's there's support right there, about 322.46. Again, here's a stock, one of the big FANG stocks, down 16% just in the last few weeks, and I could go on and on and on. I could go talk about the weekly charts, which we'll do, and I want to wrap up there, and then we'll move on to a couple other things, crude, gold, and silver, and things like that. But you had the big sell signals here on the weeklies. As mentioned recently, you had the bearish PPO crossovers on the weekly, and although sometimes those prove to be a whipsaw signal, but quite often you get in there early on. The biggest corrections and bear markets that we've had for not just years, for decades, you'll get that early on, those crossovers there. So a lot of technical evidence, to not only get short a couple weeks ago, but to be short at this point in time, and potentially to stay short and hold out for some additional targets. So we'll see. Take it one day at a time, minute by minute. I'll do any updates if I see anything I missed, but that's it. I already went over most of the market-leading stocks. Then Amazon. Here's how Amazon looks on the weekly. It's been in this multi-month, almost over a year-long trading range. A little whipsaw signal there, and again a divergent high, and that's the big thing. That's the takeaway here. All the recent indicators, all the negative breadth indicators I've covered for weeks now, and big divergent highs, not just on the 60-minute chart. I've been focusing on those since the day the rally off the COVID low started. I pointed out every divergent high and divergent low that we had on the 60-minute charts, and I pointed these out, and these continue to grow, and these are the ones where the big drops come from. 36%, 14%, 32%, all following divergent highs on the weekly chart. So work to be done, and what's that work for Amazon? Well, you got to break that multi-month trading range. It'll help to see the 200-day moving average get taken out. The red line is the 40-week exponential moving average. The 40-week exponential moving average is the same as the 200-day on a daily chart. All right, so 5 days in a week, 5 times 40 equals 200. And yeah, there was a period where it slopped through it there, but the 200 does a really good job on a lot of tech stocks and high growth companies like Amazon. And so again, if it breaks that, here's a long-term trend line that it hasn't visited in a while, the primary trend line on Amazon, and that's a potential swing target. So I'm doing the video to give you guys both near-term and longer-term targets. If things get ugly, that'd be about a 29% drop or so, depending on if and when we get there. All right, changing gears, quick update on Natty, natural gas. I gave you a straight trend line and a horizontal price level on the other chart. I wanted to point out this chart. This is a different board I have on stock charts, and it shows, if you recall, when lumber went parabolic earlier in the year, I warned of a very powerful correction to come once that parabolic trend line was broken. This is natural gas, but does the same thing. Every now and then, it's very volatile, but every now and then it goes parabolic. This is a parabolic trend line. And that's the nature of this beast. You go parabolic, and it looks like natural gas is going to go to the moon, but what happens? It becomes overbought. You can see here on the RSI an extreme overbought readings. Sometimes you get divergent highs, like there was a divergent high right there. So you had a sharp up, leg down, another high, which was a divergent high, and then you get these powerful corrections. But the bottom line, when you go parabolic, just like lumber, just like almost any security out there, with Bitcoin, you name it, parabolic runs, usually don't end with normal corrections. They usually end with near vertical drops. So that's probably what's coming there soon in nat gas. I know right now it seems bulletproof, but big down coming, just like we got in lumber after the parabolic run we had earlier earlier this year. And crude oil, no change there. We're right back to that area, that big level, roughly ballpark $76. Mention it here. We had the biggest pullback in many months with that divergent high. So again, it's not as if it didn't pan out. We had, for active trades, we had couple counter trend rallies that were called in there to trade the bounce. Then we put in a divergent low in the 60, and we made another test of that, which a few weeks back I said was, quite likely or possible, very possible to do. Even pop it, we can even pop it, and we're slightly above it. I think crude today, it hit a high of 78 or something like that. That would be a marginal new high, but again, big divergences and simple stuff, at least in my book. Wash, rinse, repeat. Divergent high, divergent high, divergent high, divergent high, divergent high. You can see all the divergent highs on here, especially when they're coupled with overbought readings. And likewise, you want to go long on these oversold readings, especially when you have divergent lows. I don't have all of them marked here. I'd stop marking them back there. Oh, there's one, but you don't see the green arrows. That's when you want to get bullish on crude. This is when you want to get bearish on crude. And just once again, I like to loop back to this chart to remind those that aren't familiar that crude in the stock market tend to move highly correlated, and there are periods that, just like any asset, two assets classes that are highly correlated, there are periods where that correlation will disconnect for a while, but there's always a mean reversion. And if you want to look here, one thing you can do is go to here. I'll do it this way. It might help you see it better. Start them at the same point. Okay, remember, they're not on the same price scale, so you're seeing prices different. You just look at the trend. Here's, I'm sorry, USO is in blue, oil, that's crude oil, and SPY is in black. You have a down in crude, you had a down in the market. Again, don't underestimate, that's a big drop in the stock market. It's just a scale, and crude tends to move more in percentage terms, both up, both down. Actually, I drew over my arrows there, both down. You can see it. It's pretty clear. And there was a period of disconnect, but look at that game of catch up. Other than that, you can look at all the peaks and major turning points in both, major corrections, major bottoms of both. You got it. So all right, so you can see that it's unmistakable. Again, there are periods like recently where they disconnect. That disconnect can last for a while, but sooner or later you're going to get a mean reversion. And so, how much, when oil reverses and starts to move down, takes the next leg down, will likely depend on what the stock market's going to do. We only have, what did I say, few percentage points, 2.5% or so, till we hit some pretty good support where the markets could bounce. That could continue to give, tailwind to the crude trade. But, sometimes the reversion will just start to, the mean reversion will begin when you least expect it. So we're going to trade crude on its own technicals, and right now I'm watching to see if we get a failure back below that big resistance on the weekly chart I just showed you on WTIC. Before I get to gold and silver, I just wanted to point out something that's been on my radar for the last week or so. Is I can't remember if I brought it up last week. It's LE, live cattle. This is a 6-month chart, so 2-hour candles here. You had a positive divergent low around this support level, right there about 125 or so on live cattle futures. The closest thing to an ETN for this, or an ETF, you have the ETN called COW, C-O-W. It has both live cattle and lean hogs. But I don't, to the best of my knowledge, there's not a pure play, and they do have different charts right now. Hogs had rallied recently; they're been up. This one was lagging behind. They usually move together, and so what you're seeing here is positive divergence right there. Just like we had a divergent low at the same support back here, led to this rally. Actually, before all said and done, it led to this rally from there. Now we have that. Minor downturn. I'm not crazy about the downtrend line, but I like the fact we're coming off support with a divergent low. So there's probably more upside there if you're looking to diversify. Again, live cattle have virtually nothing to do with the stock market, so it's all part of trading a diversified portfolio. Portfolio. LE. That's the symbol on live cattle. Next up, let's do gold and silver, and I think that's it. Let me find that chart for you. GC, gold. Okay, and we put in that divergent low as recently highlighted right here. I had an impulsive move up last week. We have a trend line here to deal with. Probably get a reaction there, which we did, pull back, and now boom, breakout. So that is a buy signal or an objective time to add to a long position in gold. A lot of work to be done, a lot of resistance levels, but the big level in the target that I would look at here is still that 1838-ish level right there. I'm going to have to soon zoom this out to a 6-month chart. But again, I just want to point out that we did break out, and it comes on the heels of that divergent low. So I am near-term bullish on gold and silver. Let's look at silver, which also broke out. SI, silver futures. This is a 6-month chart. There's our primary downtrend line on the 6-month chart. Big divergences set up, positive divergence, bullish divergence at the recent lows. Then we took out, went ahead and we took out this minor downtrend line. So both silver and gold have taken out. Remember, gold, we were looking at a 60-minute chart. So that's half of what we're looking at here. This is a 6-month 120-minute chart. We were looking at a 3-month chart with 60-minute candles. So that's comparable to the breakout in gold. So they both broke out. That's what I like to see. And they both have, resistance overhead. Next target's about just over $23 on silver, then 24 plus a downtrend line, and a break above that would be quite bullish. And that's, minimum. That's what I'm looking for. Rally up to that level there. And so you're looking at a good 5, maybe 6% from where we're at right now on silver. And then, of course, if we break out quite a bit more, the dollar, let's look at the dollar and euro because they certainly have an impact on where gold and silver are going. This is DX US dollar futures. For many, many weeks now, I've been talking about these divergent highs. We had a nice setup here, bearish rising wedge divergent high, and it did play out for a correction. We hit support about 91.79 or so right there. Had a bounce, put in another marginal new but still divergent high at that point right there. Another correction, even a bigger correction, right, to the same level. And then what do we do from there? We extended the same divergence. It started back here at this point. It has only grown larger now. And we're starting to reverse. All we need to do is take out this trend line, which I suspect we will. And I would say at least come back down to that same target again. Watch, rinse, repeat. And it's just going to be a bigger drop this time if we get down there to that 91, we'll call it 91.80 level. Makes sense because each time we've had bigger and bigger divergence. And by the way, that would be quite bullish for gold and silver, and that's the whole point of covering the dollar because dollar and silver tend to move inversely to one another. Okay, let's wrap it up here where I started off with the index futures. Again, NQ NASDAQ 100 is at support. I have it at 14,428 now as I'm wrapping the video up, which is right around that 14,434-ish support level. So where a reaction, we may not get one. I'm talking a tradable bounce, might go a couple percentage points, but whether we do or don't, hard to say, but I do favor another move down there. And I also think any bounce is going to be relatively minor in both scope and duration, how far we bounce in the amount of time. So that's what I'm looking at. All right, we'll wrap it up here, and if anything changes by the end of the day or I see anything else that stands out, I'll get another post out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.